Morning. I hope everyone hears me. So I'm feeling Olympic today. That's a quote from the movie or whatever. That's a funny movie I used to watch with my kids. You have the bobsled team from Jamaica doing the Winter Olympics. That's the one I don't even remember the name, but that's where I'm feeling Olympic today. Yes, and it still makes me laugh. Anyways, so let's wait a couple of minutes so maybe a couple more people can join. As usually, say hello, my friend. And I don't know if you've watched the opening ceremony yesterday. Honestly, there were beautiful moments, but there were other moments that were cringy AF. If you see what I mean. The artistic world in France is even more woke than what you can find in the US, if you can imagine. So that explains a lot what we've seen yesterday. Uh, Whatever. I just don't want to expand because too much on this because I would not be very sympathetic to what I saw yesterday. Anyway, there were still beautiful images. I mean, the Eiffel Tower is beautiful. Like this, what do you call this? The flame is beautiful as well. And just quick checked this morning the competitions, and actually there was cycling, and I mean the competitions, the venues, the events inside Paris with all the historical monuments behind. I feel this is really beautiful. It's amazing. So now that the opening ceremony is over, I believe we are done with this until the closing ceremony, and we'll have some amazing competition and sport. So I guess that will be great. Again, I really found this morning that seeing the competitions um, inside Paris with all the monuments, the historical buildings, it was really, really beautiful. So, what time is it? So we are already 3 minutes in. I guess that if people are not here, they will catch up on video. Remember that it's always available, on LinkedIn Live. Also here on LinkedIn and on YouTube as well, on the channel Counteraction. It's pretty easy to figure that. I haven't even checked actually, because that YouTube channel is basically sleeping. The only thing that goes there at this time is these weekly shows. I mean, I have trouble calling this a show, but anyway, so you can find it there as well. So let's start. So like I said, today we'll be focusing on markets. I hope to have a couple of questions about the markets. Otherwise, I say what I want to say, and that's it. So we'll go much faster on the geopolitical side and the economy side. There was not much exciting stuff to say anyway. Specifically in geopolitics, it's basically more of the same that we have had the past week and even the past months, if you consider the wars that and the conflict that happened in Ukraine, Israel, and so on. So little more of the same. So let's go. So we'll start first with our friend Joe Biden, that has been pushed out of the race. I mean, it was amazing that this way it happened. They literally forced him out of the race to push their new. No, I won't say it. To push a new candidate, Kamala Harris, which again, like I said before, fits all the check marks of identity politics. from the left side. What's interesting is that Kamala Harris has been selected, as you've seen, not elected, which is kind of ironic considering that they claim to be the party of democracy. I mean, it's also interesting that well, it's a bit early considering that she's been only in the race now for a week, but I'm really curious about who she will choose to be her running mate for this presidency, because it has to be a big name, in my opinion. If she stays there, obviously, there's still time to kick her out as well. As a reminder, before the Democratic Convention. I'm really curious about who she'll be running with, because she's very unpopular. So she needs someone to fix this. And what the other point is interesting is that that she was endorsed by most of the big figures on the left, but not by the Obamas, which was kind of giving a hint that maybe Michelle could go. So Kamala has been endorsed by the Obamas a couple of days ago, maybe yesterday or the day before. I don't remember. Who cares? So she seems to be now the nominee, unless something happens that could change. And we know that things can change and happen very rapidly. So we'll pass on this. Because again, I mean, I think the biggest point is that Kamala Harris is very unpopular, even within the Democratic Party. She's a very far left candidate, although that the media that who started pushing her like crazy since she's been, the front runner for the Democratic Party. They switch totally their what they say about Kamala Harris. She went from a nobody and popular to. At the same time, you've probably seen that her past. So I seem to be back. So what I was saying basically is that Kamala Harris' past is being erased from internet. It's pretty insane to see what's happening now. I mean, it's the same, very similar. I lost my English. It's a very similar situation as narrative building as what we had during COVID. So I mean, it's really insane. But I have no doubt that people will do what they are told to do. Again, COVID shows that. So if people are told to vote Kamala Harris, they will probably do so, which is unfortunate, but that's how it works. So a little bit of real geopolitics now. So Russia is really considering sending weapons to the Houthis to control the Red Sea, in a move to basically another proxy conflict against the U.S. from Russia, a kind of retaliation of the U.S. providing weapons to Ukraine, obviously. And this starts to be a concern for the U.S. At this point, because this is probably, so I will come to that later, but this is probably where the global conflict may escalate. I will talk about this in a couple of seconds. So next, what was important this week, you had Netanyahu's speech in Congress this week. It was more than very well welcome. They counted this guy had 70, not 17, 70 standing ovations during his speech in front of the Congress. It's for a foreign leader. It's insane. I mean, that just shows basically the close connection between the US and Israel at this point. I would say it's nearly the same. It's nearly it's still nearly the same thing, and this is probably the conflict that may drag the U.S. into a global conflict with Russia and China. So how it may develop. So we've talked about this before. So basically, the Gaza Strip is controlled. Netanyahu mentioned in his speech that the future of the Gaza Strip is to be pacified. But I mean, it's impossible at this point, because every kid that has lived what happened over the past weeks will be considered a terrorist in 20 years. Basically, that's what happens. So it will never be able to be pacified as long there will still be kids that have grown in that kind of environment, because they're only fueling revenge for the future. That's basically how it works. For instance, before the US starting, carpet bombing the Middle East, there was no risk of terrorism inside the US. The first Iraq war was in 1991, if I remember well. And this what has built the anti-American sentiment in the Middle East. But anyway, so basically they are preparing the future's catastrophe in Gaza, in my opinion, and probably one of the reasons that if they actually really want to fix the issue, they have to go much beyond the Gaza Strip, and that's probably why Israel is now focusing on South Lebanon and attacking the Hezbollah, which is driven by Iran. So my point is that probably the objective, and the obvious objective, is to have a bigger conflict with the Hezbollah in South Lebanon, which will drag Iran into this conflict. And if Iran is dragged into this conflict against Israel, then at this point the US will come, and if the US come, Russia and China will come on the other side. So that's probably what will trigger a major global war in the US, and basically that's the theme of the editorial article that was that appeared in Forbes this week, and I totally agree with it, because I mean this all makes sense. It's kind of obvious of where we go at this point, and which makes the November election even more critical, because if it's it's the same of the current administration, we are going to a World War III. It's obvious. I would say that there's a lesser chance with Trump, but if Israel is attacked, Trump will go into that conflict anyway, so that wouldn't make change, make any difference. If the war would have started in Ukraine against Russia, then Trump stops it right away. But I don't think that Trump would get away from a conflict to protect Israel. So maybe we're done with geopolitics right now. We can switch to the economy, and so I don't know if you've seen, but the GDP for Q2 was better than expected. It rebounded to twice as much as it was in Q1. I think it's the growth was 2.8 when it was 1.4 in the first quarter. However, and that's a big however, what you see on the screen right now is how much you had GDP increase for every dollar of debt. So if you look in the mid 60s, you had $1 of debt. The economy was generating more than $9 of growth. So it went back. It went back to zero in the early 1990s, and with the internet bubble, for $1 of debt, we had $4 of growth. And since the crisis in 2008, we have less growth for every single dollar. So today we had 58 cents on the dollar of growth per dollar of debt, despite the massive run in the AI economy that we've had recently. So maybe let me check one thing. Oh, I have. Oh, I'm sorry, guys. I didn't see that I had I have LinkedIn users. I mean, for some reason, some people are not here. So yeah. So we have Enric, my friend, always there. Get us back to war. Yes, that's exactly what I was saying. Just that if the war spreads in Israel, there's no way that the US can avoid this. They would be dragged into the US would be dragged into war pretty obviously. I mean, it's just we know that who is driving the country. Eisenhower said it before me. It's not news. Eisenhower. How do you say that? Anyways, so my friend Eric, a lot of comment. Thank you for commenting. You trust any numbers provided by the government? Well, actually, this one is a research committee, so it's not that much of exactly government numbers. Time to move to Namibia. I'm sorry, I'm disrupted by this guy. it's so funny. Namibia looks to be a very beautiful country. You know that. So I mean, you'll disrupt me. I'll probably go beyond what I was supposed to do. But anyway, who cares? People want to live, they live. They want to stay, they stay. Time to move to Namibia. As a photographer, Namibia is a beautiful, really beautiful country. There's a lot of photographers that go there to shoot. You've probably seen some of the most popular photos from Namibia, except from the wildlife, which is when you have the dunes, the sand dunes going into the sea. It's insane. It's a really beautiful sight, and I really love to go there and move to Namibia. Buy a case, a hut, I don't know how you call this, and live there on the beach for what's left of my life. That would be a great idea. So only this to say, back to this. That sorry, no, sorry. I know, my friend. I know where you are. No problem. If I wouldn't like it, I would skip all your messages anyway. But I don't, because it's cool. So let's go a little bit faster. So that's the really big issue. And so what do we do now? It's this. So the issue of the debt, where we have a big debt that is only creating half of it, is creating some growth, and now we have started basically into let's say debt loop. With the hockey sticks, that was only projected before. Now we are exactly on this path of the hockey stick that will send interest payments to the roof. Nobody knows who will pay for that, because obviously the US taxpayer will be broke at some point. The other countries will not buy our debt because the credit risk will increase in the US. I have no idea where will the money come from, except from printing the money, basically, which is a technical default at this point. Which means again inflation and all the consequences that we've mentioned that we've mentioned already. So that's the really big scary part of this, which is the really a dead bomb. What else did I noted yesterday? Yesterday is when I started preparing this. Yes, we've seen that. I know a couple of mentioned during the earning calls. You have CEOs making mentions for weak demands, and that's exactly what they're tracking. And the mention of weak demand per company during earning calls have risen to levels not seen, since the GFC, the Great Financial Crisis, and 2020. COVID crisis. So it's really significant. It's another sign that the economy is not doing as well as it is said to be. They are, so I have expressed concern about future growth in the US, and basically that's kind of another sign. We had some numbers in terms of the activity index. The Richmond Manufacturing Index is not good. They are negative at this point. So specifically the Richmond one, I mean, it seems to be potentially signaling a recession at this point, and we can maybe see this. In the market later. You've seen that, despite or because of the large increase of the market, insiders have started offloading their stocks massively. They have sold more stocks than in a decade at this point. So I mean, if the insider of companies are starting selling like crazy, they probably first, the one logical reason, which is cashing in, obviously, on the gains, and the second reason might be, or maybe, this expectation for the market for their companies is not justified. So this is where we're going at this point. So we'll move to the markets right now, which I expect to spend maybe the last 20 minutes, so that we can go until 11 a.m. Oh, I say hello, but so if someone has questions at this point. So I will take this time just to show you. I don't know if you've seen, because my website is basically sleeping, but I am trying to revamp it slightly. So now to access the private Croissant files, which is sleeping as well for the summer. But for the summer, I let me know what you think about the comments. I won't be doing any private Croissant files for accredited investors during the summer. But what I want to do maybe is to do an open conversation, maybe once or twice a week for now during lunchtime, something like this. I don't know. Tell me what you think about it, but you can still sign up for the private Croissant file again. That will start definitely at the beginning of September in a regular schedule. We're going to my website, quantaraxia.com not dash slash PCF sign up. I was using a platform to be able to do that before, and now I've taken everything on my side, and which gives me much more flexibility on what I can do in terms of staying connected with you guys. So you can go to www.quantaraxia.com/PCF sign up, like private Croissant files sign up. That's pretty easy. I won't bother you much more with this. What I'd like for you to do is to have some questions about the market. So let's start. So what you see here is the heat map from of the market, US stock market, US equity stock market. It's tough on Saturday mornings, guys, where everything red and when everything was green yesterday. So a lot of volatility on the market as coming with again the rotation. Do I have it next? Not exactly, but this is just a chart showing that Chinese investors have dumped record amount of U.S. securities participating into the kind of sell-off that we had this week. But that's not what I wanted to show you. Not this one either. What did I do? I mean, it totally messed up my the order. So, okay. So what do we see now? Let's do this. Woo. Okay, so now you see it's basically what happened. This had started the week before when we had a rotation from big caps to small caps, specifically from the Nasdaq, which was driven again by the MAX 7654321, as I said, basically Nvidia. And the AI revolution, but we have to remember that the AI revolution is not there yet. It's only projections on the future. So it's probably blown up a little bit more than it should be at this point. And I think the correction on the Nasdaq is totally justified. What is concerning is basically the same as what happened in April. You see that the drop is very, very fast, and that's the kind of event that can that can derail into something more serious. So I prepared this chart yesterday, so we don't have the little correction of yesterday. Just if any of you notice. So, and that's the kind of event that usually triggers some volatility event again that can derail into something more serious. Let's try to move this here. No, that doesn't work. As you can see, I'm not totally fluent in manipulating this thing. Anyway. Yeah, I know, and that's exactly the reason why I started revamping my website. Just as a comment. Why? Because in terms of funnel, so basically client connection and potential acquisition, this is exactly why I want to control my website, to be able to manage it the way I want, and for people to be able to see some interesting content about what I do, not only the stuff that I mentioned here. Thank you, Enric. Permanently in the footer. So let me go back to, so this guy tells me to put that permanently in the footer, and that's what I do. Thank you, Henry. Oh man, I need a guy that kick my to make sure that I do what I need to do. So basically, what I was saying is volatility event. So you've seen we have some volatility spikes here and there. You see that the volatility is compressed very similarly as it was compressed in 2017. That led to what we called Volmageddon in 2018 at this point. So the volatility is massively compressed at this point, and it works like shark spring. If you compress, at some point it has to snap back. Thing is that so volatility is increased. The term structure is not exactly today in backwardation, but it's nearly flat. As you can see, the VIX is above the VIX future right now. The first maturity of the VIX future, the first maturity of the VIX future is still below the second maturity of the VIX future. Why? Because you also have, we are getting close to the October maturity of the VIX term structure, which includes options that goes after the election. So this includes the election risk, and obviously, if there's still uncertainty about the election, this should go probably. So volatility should go up rather than the term structure collapsing to the VIX spot. We'll see how it goes, but there's a lot of uncertainty around the election at this point, and this seems to be one of the major reasons why the market really reverted. If you see, and if you look at the market, the S&P 500 versus the probability of a Trump victory. So once Kamala Harris, so I mean, after the debate, obviously it was clear that if it was Biden showing up at the election in November, he would lose. Now you have more uncertainty because everyone needs to find out and figure out what the Harris candidacy will look like, and so the probability of Trump winning before Biden dropping out was 70%. Now it reduced to 56% or something like this. I don't remember the number exactly, but it's in 50 or 60, 50, yes, I think that's it, 56, 57. So it dropped. Usually Trump is seen as more positive for the market than a far left candidate. But so basically you see the impact at this point. The second point was that weighted on the market was some carry trade unwind when you see the tech sector versus the dollar yen. This is what we see. We have the same thing with so USD MXN, that's what you have, but the Mexican peso versus the yen as well. So I mean, it's interesting because, and it gives some volatility, because when you have that kind of carry trade where they have massive amounts of money that plays that trade, when it reverts back, it's usually very violent, because it's the situation where one day of P&L can erase 1 year of P&L for these carry trade traders. So it really generates some of volatility moves. So going back to volatility, I don't know if you, or maybe you've seen, maybe not. You had Mark Spitznagel, the head of Universa, the tail risk hedging hedge fund, that said that that kind of event may spill into a much bigger event and kind of a crash. Which, to be honest, again, with the crazy AI numbers and the concentration in only a couple of stocks, may well happen. I don't know, and that's why I have my not an investment advice. Yes, I prefer doing this because just to make sure that there's no confusion. So there may be a volatility event. That's at least what this guy from Universal, Mark Spitznagel, said. One of the other prominent guy in this fund is what's his name? The guy from the Black Swan. I have the book behind. Nassim Taleb. Nassim Taleb was I don't know. And I can basically confirm this because that we are at an inflection point, because that's a point where basically my personal tail risk hedge is on the flip side. Basically, it's getting ready to step in if there is a bigger event, to hedge a bigger event. So that's interesting. In my opinion, I was happy to see that what I'm doing was confirmed by someone that is pretty well known about this. It's always good that you have some confirmation about what you do. So obviously, I mean, we are in the middle of the let's say crossing the road. I would say the two options at this point. When you are getting ready to hedge, basically this is a cost that if the market reverts, because obviously you won't capture all of the upside. But on the flip side, obviously, if the market collapse, then there will be the hedge. I'm not saying that my system's tail risk hedge is suggesting a hedge. What I'm saying is that there are some signs in the systems that it may implement some hedge in the very near future. Again, not in investment advice. Don't do anything that you would not do if I would not say that. So, but just to give you an idea, this is about an inflection point. This is a point where I mean, it will sound like obvious, but you can have a sharp reversion on the upside, like we had in April, for instance, or a bigger collapse like we had in 2018. Okay, so basically, yeah, I mean, I should have shown that bigger than it is now, but it's a kind of basic term structure indicator, and basically that kind of indicator shows that the term structure is nearly flat at this point, which is when you go from contango to backwardation and when you are a more significant crisis. And as you see, 2018, boom, you had this one spiking, 2020, boom, spiking like crazy. And this is obviously when you want to hedge. But to be able to hedge that part of the curve, you need to be able to take small losses on the hedges like this. That's basically my point. So we've seen that the rotation into small caps. Another vision of this, which with the spread. The spread is reverting pretty massively and rapidly. Again, I said that the week before. The last time it happened was when at the top of the okay, sorry, I'm looking at messages because my Enric is doing my after self-service. I don't know how you say this, but anyways, thank you, Enric, for that. Okay, I will probably be beyond what the time that I was thinking. But anyways, I mean that is fine with me. So reversion. Last time that level of fast and violent reversion happened on that side, because obviously you had some collapse of small caps versus tech before that were as violent as well. But on that side, small caps recovering when tech stocks were collapsing was at the top of the 2000 bubble. I think I mentioned that already last week. I like this graph. The reason I show this is because I wanted to post about it this week, and I forget. I'm doing a lot of work on the systems on the website, and just more technical work that nobody sees. It's mostly behind the scenes. So, but this one I wanted to cover this because this is when basically when you see that the white line is breaking on the upside. This is the spread between the S&P and Treasury bonds, and basically what it shows you is that when the 60-40 portfolio collapse. And what does it mean? So 60-40 portfolio or even a risk parity portfolio only works well as long as on the long term you have a similar performance in bonds and equities, because it cancels out. You have some so the volatility cancels out. You have some diversification, so you have basically very similar performance with a much lower volatility. That's what we had until 2020, and then 2020 with the COVID, the debt, people realizing that this will be an issue going forward and put pressure on bonds and interest rates, inflation. Now that we have a very large discrepancy in performance between the stocks and the bonds, the risk parity 60-40 is not a viable option anymore. So if you are, let's say, a 60-40 or risk parity manager, the only option that you have to do is to kind of get rid of bonds at this point, because no one will pay you to have something that is underperforming massively the stock for the same level of risk, because again the correlation increase, you don't have any kind, not even diversification, so you don't get the performance, you don't get the diversification, and basically I think that's the best way to show the death of both 60-40 portfolios and risk parity portfolios. So what can you do? So the only thing that you can do at this point, if you are not really risk averse and you believe that the stock market will go up forever, and this is usually the point that people do, invest in stocks because it always go up. Yeah, it always go up until it doesn't. Just it's as simple as that. So I think that kind of graph shows again that active management will be coming back. The only thing that we'll need, so obviously we've seen along the many previous year a big influx in ETFs. That was driven by the fact again that liquidity injection in the market is propelling the stock market up like crazy. But that might not be working all the time, specifically considering the situation of the market that I've mentioned before, huge concentration, market pop up by massive liquidity. If we have really significant downside event on the equity markets, probably people will see again the interest of active management. Well, in my situation, because everything that I do, I invest. This is first for me, and then I offer this to potential client. That's basically how I work at this point. And so what I was about to say is, I don't even remember what I was saying. Yeah, so my point is that I would not invest passively in an ETF. My ETF strategies are active strategies. I wouldn't be a passive investor. Well, that's not that's not how I am. So if we look at basically now individual other segment of the market, what we see here is, so it's DBC, it's globally the commodity sector, if you like. And what does the commodity sector say? It's not going really up. The reason that I draw these two lines, it goes back to my early days when I was investing with technical analysis, when I was 18, 20, something like this. I had a lot of fun doing this actually, before becoming a quant after that. But the reason that I draw this is that I really like, as a technical analyst, this line converging towards and volatility compression. Why? Because usually it means that when it breaks that pattern, then you have a volatility increase and a significant move that can be captured. So that kind of pattern is, I find, is very interesting for me. And basically at this time you just wait just to see where it will break, on the upside, on the downside. But wherever it breaks, it will usually come with an increase in volatility and a significant move at this point. The other thing that I think that this graph shows is concern about the global growth. I didn't talk about it in the economy side, but these are other concerns that weighed on market, which is China, that is struggling to with its economic activity. And I think this global commodity indicator is not spiking up, is going trending slowly down, is reflects major concerns about the global economy in the world at this point. So, and you have very similar thing on the oil at this time. Oil is not going crazy. Whatever happens basically in the Middle East, nobody seems to be concerned about the war in the Middle East, maybe because at this time the concern about global growth in the world are much more seen as much more important. And you can see that basically oil is not going anywhere. So that's, so I've mentioned issues about growth before. I think that's another sign. I often say that we are already past 11 a.m. I often say that the markets tell you everything you need to know. And that's what I usually mean by that. For me, again, I'm not an economist and it's a purely conjecture for me, but if you want to have a global assessment in terms of price about the global economy in the world, you have to look at the oil, because oil is consumption of energy. The world is driven by almost, many would like it to be driven by electricity, but it's still not the case at this point. And oil will probably be the main driver for energy in a very long time. So when you look at the price of oil, basically it tells you where the economy is growing. What you had, for instance, the big drop at the beginning of this chart, right above Henrik logo, is the drop that happened during the 2020 COVID crisis, where everyone was expecting a massive reduction in terms of economic activity because of the lockdowns and everything. So obviously oil collapsed before it started, the COVID crisis started easing and recovering, and so oil recovered at this point. So oil at this point, not spiking up and inching down, to me, reflects the concern if the global economy. So you have gold on the other side. Gold inching, hovering around its all-time highs. Given the injection of liquidity, it's not surprising when you see that they are already talking about cutting rates, which potentially lead to higher inflation and then currency debasement. I think that's the reason why gold is there. It's a move away from fiat currencies, plus other incentive from the for other drivers. From the BRICS. But basically, that's what I believe this chart means at this point. I also believe that's what what these charts mean as well. Similar as gold, we have Bitcoin that is around its all-time highs. You remember we had some correlation going much higher between Bitcoin and the Nasdaq, so an alignment of Bitcoin with the tech sector. So the correlation has reverted to a negative correlation. So short term, let's say it's 1, 3, 4 months, 6 months correlation is now getting negative with the Nasdaq, which is a good thing. It provides diversification, but it shows that playing Bitcoin is not a leverage play on tech. It's a little more than that. Most people involved in the crypto sector, or trading or investing or saving value in cryptos, in Bitcoin specifically, have other reason to invest in Bitcoin than simply playing a hyper leverage version of the tech. And that's what I believe as well, that the negative correlation with going back to the negative correlation between Bitcoin and Nasdaq shows. What else on market do I have? Yes, that's the treasuries. So you've seen that despite the narrative of cutting rates, I mean the bonds do not go up, whatever that means. So it seems that actually the market doesn't really believe in rates going down very significantly, which again may be linked to a couple of factors. So we have mentioned the US debt and currency debasement and everything that goes into the play of bonds going down, potentially, inflation that is not expected to go as low as it's supposed to now, specifically if the Fed wants to cut rates very rapidly at this point. So yeah, this is where we are now. The market, I believe, is painting a slightly different picture than the narrative that we have in the news or even market commentators. So that's, I believe, is interesting. But the main condition at this point will be the November election. We know that it drives so many things in the world, not only the US. Obviously, the US market is the biggest market in the world. So whatever happens in the US spills on the world after that, not only because the financial position of the US, the military position of the US, basically, the November election will be very, very critical. And if you want funny thing to conclude this this little presentation or show or whatever you want to call it, is that Jim Cramer himself thinks that Harris has a great chance to come on top in November. I leave you with that. I don't have any more comment on or question in the chat. Again, that was great to see you, my friends. I want to thank you for being here. I try to be, to give my view on the markets at this point. I think that if you want one takeaway about the markets, it's probably this one and this one. Basically, we are, I believe, at a turning point in the market. Turning point, no, not turning point, an inflection point, a point where things can change. Basically, you come at a crossroads, okay, you go left, you go right. That's basically it. So I think that's the main takeaway from this. Don't forget that we are late July. We're going into August, which usually a lower liquidity period for the US market, which means that markets are more likely to experience some large events because of that reduced volatility. So that's it has to be taken into consideration. So lower liquidity in August, and then usually in September you have some kind of volatility event as well. So we have August low volatility. You have some seasonality in September with higher volatility events that happens after there, and after that you go into the election. So I believe that there will be some sports, like we say, besides the Olympics, and that will be interesting to see how it unfolds. I hope you are prepared. I hope you are hedged, and I wish you good luck. And see, I was about to see, yeah, Tio, that's right. I agree on Jim Cramer. Jim is, his track record is simply perfect. So yeah, I get that. So I'll be on vacation the next 2 weeks. So I'm not sure if I will be able to do this from vacation. Obviously, I still run and monitor the strategy. You've shown in my post in the past the way I do. Basically, I can work from anywhere in the world. I'm having access to my servers that are all my system run on Amazon servers in the US anyway, and I can connect from anywhere in the world. So I will be following the market anyway. So maybe next week and the other week, I will only jump on a stream like this just to give you a quick update on what I've seen in the market. Not much research on what happened in terms of geopolitics or whatever. I'll probably only share a couple of ideas about what I think about the current situation, especially if something goes wrong in the market. Okay, so I won't be longer. It's been an hour, much more than it should be. So thank you for being here. Thank you for the few guys that have been here and said hello. Thank you, Henrik. Thank you, Attilio. I have other guys in the chat like this. This is a LinkedIn user. This is a LinkedIn user that is going to the gym. So thank you for being here. It's really greatly appreciated. Thank you. Enjoy your weekend. Watch the Olympics. Have fun. Take care.